Warren Buffett once said, "Someone's sitting in the shade today because someone planted a tree a long time ago." When it comes to investing, this quote rings especially true. The seeds we plant today in the form of wise investments can grow into something much greater down the road. With patience and discipline, we allow our portfolios to flourish over years and decades through the power of compounding, and dividend stocks provide fertile soil for this process to unfold. But what does it really take to construct a monster dividend portfolio that can generate abundant income streams and exponential growth? How did Warren Buffett build a fortune using dividends? Can ordinary investors like you and me enjoy these same proven principles to secure our financial futures? After spending countless hours analyzing Buffett's teachings and portfolio moves, studying the ins and outs of dividend investing, and testing different dividend strategies through turbulent markets, I feel confident we can answer with a resounding yes. Welcome to MoneyWise Investor, your trusted source for financial information. In today's video, we'll walk through a step-by-step blueprint for dividend portfolio success by harnessing the wisdom of the Oracle of Omaha himself. Are you ready to start planting seeds and growing your income for years to come? Let's get started. First, what are stock dividends exactly, and why do they form a core part of Buffett's strategy? Dividends are cash payments that companies pay out to shareholders as a reward for investing, usually on a quarterly basis. Whenever you own shares of dividend stocks, you earn a portion of the underlying profits generated by that business. Unlike price appreciation, which depends on the stock market's fickle sentiment, dividend payments provide a steady stream of income no matter which way stock prices move. In bull markets and bear markets, those cash dividends keep rolling in. This makes dividend stocks ideal for investors who want recurrent income for expenses or reinvesting to accelerate growth. Dividends also tend to be less volatile than speculative growth stocks, and through the magic of compounding, reinvested dividends can snowball into a fortune over decades. Legendary investor Warren Buffett is among the most vocal proponents of long-term dividend stock investing, with over half of his Berkshire Hathaway portfolio value currently invested in dividend-paying stocks. So what are the key principles and criteria that underpin Buffett's approach to dividend stock selection and portfolio management? Let's break down the fundamentals. First and foremost, Buffett seeks out only the highest quality businesses with wide economic moats and durable competitive advantages that enable them to maintain industry dominance and steadily grow profits over decades. This includes companies possessing powerful brand recognition, low-cost production advantages, distribution and logistics networks, high switching costs, and other defensible moats. Secondly, he demands that any dividend stock investment have multiple clear avenues for expanding its operations nationally and globally over the long run. The company should have obvious pathways to widen its economic moat over decades, not just years. Enduring and expanding competitive advantages are paramount. Thirdly, Buffett requires top-notch, shareholder-friendly management running the show at any dividend-paying company he invests in. This means CEOs and executives focused on shrewdly reinvesting earnings, maximizing pre-share owner earnings, and good corporate governance that aligns with shareholder interests. No room for wasted capital or poor oversight. Additionally, excess cash flow generation and healthy balance sheet strength provide important indicators of a company's ability to sustainably pay and consistently raise dividends over long periods of time without leverage concerns. And critically, Buffett seeks companies positioned not only to maintain, but increase their dividend payouts year after year. One key metric he screens for is dividend payout ratios below 60%, which indicates dividends are well covered by earnings and leaves plenty of buffer room for future growth. Only after implementing this rigorous set of criteria does Buffett deploy an ultra-long-term buy and hold approach, allowing his portfolio holdings to compound their dividends steadily over 20 to 30-year periods. Patience and discipline are omnipresent to his strategy. Now that we've thoroughly covered the key investing principles deployed by Warren Buffett, let's outline the step-by-step process for constructing your own dividend growth portfolio calibrated to your personal financial objectives. Step 1. Set clear financial goals. The first critical step is defining your dividend investing goals to guide your strategy. Key questions to ask yourself include: what is my target annual dividend income I'm seeking to generate? Make sure your goal is specific and measurable. What expenses will this dividend income be used to supplement? Are you focused on funding near-term lifestyle costs or long-term compounds growth for early retirement? What is my ideal dividend portfolio allocation between high-yield stocks for current income versus dividend growth stocks for compounding? What is my risk tolerance? How much volatility can I endure on the path to my goal? What length of time am I investing for? 1 year? 5 years? 10+ years? Your timescale impacts your approach. With clear, quantifiable goals set, you have a roadmap to inform each investing decision and ensure your dividend portfolio stays aligned with your why, the reasons and purpose behind your dividend pursuit. Step 2. Conduct rigorous dividend stock research. Now it's time to scour the market for attractively valued dividend payers, meeting your criteria. Use stock screeners and resources like Yahoo Finance to analyze key dividend metrics, such as dividend yield, the percentage of dividend paid relative to the share price. Yields between 2 to 6% provide a healthy balance. Payout ratio, the percentage of earnings paid out as dividends. Look for reasonable payout ratios below 60% for dividend safety. Dividend growth streak. Favor companies with long track records of constantly raising their dividends annually, such as 25+ years. Earnings and revenue growth rates. Rising profits give companies more room to grow dividends. Trailing 12-month and 5-year growth rates are insightful. Also scrutinize each company's competitive moat, growth drivers, balance sheet health, cash flow generation ability, and quality of management. The goal is identifying durable businesses positioned to grow dividends for years to come. For example, consumer staples leaders like P&G, with consistent rising profits and 56 years of dividend growth, or major healthcare companies like Pfizer, displaying steady earnings and the cash flows to support growing dividends. Step 3. Diversify across sectors. A key facet of risk management is diversification. The ideal dividend portfolio consists of at least 15 to 30 quality stocks spread across defensive sectors like consumer staples. Examples include Procter & Gamble, Coca-Cola. Healthcare, such as Johnson & Johnson, Pfizer. Utilities, in the likes of Duke Energy, Dominion Energy. This blend reduces vulnerability to any single company or broader sector downturn, severely cutting your dividend income stream. Step 4. Stock styles balance. Further diversify by balancing high-yield stocks, moderate yielders, and lower-yielding dividend growers in your portfolio. High-yield stocks provide bigger upfront income, but slower dividend growth. Think telecoms like AT&T. Moderate yielders offer a middle ground. Examples include AbbVie and PepsiCo. Dividend growers may have lower yields, but faster growth. Microsoft and Nike are prime examples. This multi-tiered income approach provides more diversified income streams. Step 5. Reinvest dividends. The power of compounding is unlocked when you reinvest dividends. This compounds your share count and dividend income exponentially over time. Even if you only reinvest a portion, it turbocharges your returns. For example, reinvesting just 25% of dividends can double your income within 10 years. Step 6. Utilize retirement accounts. Holding dividend stocks and retirement accounts, like RRSPs or TFSAs, allow you to reinvest dividends tax-free. Step 7. Monitor and manage. Stay on top of your holdings by reviewing the portfolio quarterly. Check if fundamental outlooks have changed, trim positions that are overweighted, or if risk profiles have increased. Step 8. Avoid emotional decisions. Don't make hasty buy-sell decisions during market swings. Follow the system, remain objective, disciplined, and focused on the long-term goal. Step 9. Continuously learn and improve. Strive to constantly expand your financial knowledge by reading books, news, and quality investing content. Never stop improving as an investor. Step 10. Stay the course. Time in the market beats timing the market. Patience and discipline are integral. Tune out short-term noise and stay focused on your long-term objectives. Designing your portfolio using these 10 research-backed steps can significantly maximize your dividend returns and chances of generating your desired dividend income. The key is constantly reinvesting those dividends to compound your wealth exponentially. Be rigorous in your stock selection process and remain focused on the horizon. If you build it the right way, your dividend machine can generate abundant income for decades to come. Now let's briefly highlight some real-world examples of dividend stocks in Warren Buffett's portfolio. Coca-Cola, an iconic dividend aristocrat with 59 consecutive years of dividend increases. Coke's unrivaled brand equity, distribution network, and global growth provide huge advantages. Apple. Surprisingly, tech giant Apple is fast becoming a dividend juggernaut. Apple has grown its dividend over 110% in just 5 years. Its massive cash hoard ensures many more decades of growth ahead. Johnson & Johnson, this well-diversified healthcare leader, has increased its dividend for 60 straight years and maintains a very safe mid-40% dividend payout ratio, leaving plenty of room for ongoing growth. Procter & Gamble, a stalwart consumer defensive stock with 66 consecutive years of dividend increases under its belt. P&G's portfolio of leading brands enjoys steady, recession-resistant demand. American Express, not traditionally seen as a dividend payer, Amex has nonetheless increased its dividend for 27 consecutive years as its global payment network expands. Bank of America, the banking giant, has more than tripled its dividend over the last 5 years as profitability has soared. Rising interest rates provide a tailwind. McDonald's, the fast food titan, has raised its dividend for 45+ straight years. MCD's real estate ownership, pricing power, and globally ubiquitous brand provide huge competitive edges. United Health Group, America's largest health insurer, displays excellent dividend growth with increases, averaging near 20% over the past 5 years as the business sees surging demand. As you can see, the market offers a diverse menu of dividend growth opportunities, spanning various sectors when applying Buffett's selection methodology. The key is constructing your portfolio using his principles, reinvesting patiently, and letting your dividends compound over your time horizon. I hope this deep dive has provided you with an empowering game plan to achieve your dividend investing goals. Please let me know which dividend stocks you find the most attractive. And don't forget to like, subscribe, and turn on notifications. Thank you for watching, and until next time, stay money-wise.